Welcome to Common Sense Investing. My name is Cameron, and from April 22nd to the 24th, MicroCap Club is teaming up with Planet MicroCap to bring 400 plus microcap investors to the Planet MicroCap Showcase in Las Vegas. This event so far has 77 companies registered to present to microcap investors. And my goal is to research every single one, hopefully finding the best companies, the best stocks with the best presentation that could impress investors at the microcap conference and send the share price higher. All of the stocks that I research are on my Patreon Discord, which you can find a link to on my website or down below in the pinned comment. And today I'm going to introduce one of the first stocks that I researched from that list, FlexShopper. And FlexShopper piqued my interest for this first video, mostly due to their significant growth, talking about customer application volume up 130% year over year, as well as a focus on reduction of expenses and potential profitability in 2025. FlexShopper is a NASDAQ traded microcap stock with a market cap today of roughly $37 million, a share price of around $1.60. Now, this is the tale of two companies, because in the past year, FlexShopper is up 37%, pretty decent returns. But on the bottom chart over the past 5 years, down 43%. So a little wobbly. What is the real FlexShopper? Is this a company at an inflection point that's about to take off? Or is this another spike up in their share price followed by another drop? So what do? Here's their website. Looks a little bit like Walmart. High-end appliances, PlayStations, televisions, computer monitors. Are they a store? Kind of.
If you want a new product but don't have the cash up front or good credit, try FlexShopper. With FlexShopper, you can lease to own the brands you love in 4 simple steps. You'll have the flexibility and freedom to shop today and pay over time. First, apply easily, quickly, and securely online, and get a decision in seconds for a spending limit of up to $2,500 that you can use on one or multiple products. Next, browse the latest and greatest products on the FlexShopper marketplace. With more than 80,000 products, you're sure to find what you're looking for, all with affordable weekly payments that make ownership possible. Then, with just a few clicks, accept the simple electronic lease agreement. You can have your product shipped right to your door, or choose quick curbside pickup for some items at your local store. After you receive your item, your easy, automatic weekly payments begin. Make all your payments for a year, or pay off early, and you own it. Now, start shopping today.
So this is their business model. Asset-light dual-channel model. FlexShopper provides consumers with immediate purchase power to buy products through FlexShopper.com. That's their website. You could go here. This is a business-to-consumer channel where you're buying products, you're paying per week over 52 weeks, and I believe that's up to about $2,500. They have 77,000 SKUs from top retailers. They also have a business-to-business channel where FlexShopper provides retail merchants with greater consumer demand and higher sales conversions by providing a payment option on a retail partner's e-commerce site or brick-and-mortar location. Significant growth in retail locations over the past 3 years. While sometimes I'm hesitant to invest in these financial software companies because they can be so easily replicated, FlexShopper is saying that their IP is protected with a variety of different patents. So that's the business. It's interesting, right? There's a lot of potential here with the economy getting worse, with people still needing to buy things, with the way that people are just so willing to take on more debt these days. This does seem that a company that I would be bullish on. But there's always risk. And before I get to the numbers, I have to remind you, I'm not a financial advisor. I'm definitely not your financial advisor. This is not how to invest. This is just how this guy invests. I like talking stocks and introducing them to you for more research. There's so much to unpack here. Here's their total revenue. This is for the 9 months ended September 30th. These are unaudited numbers. Their revenue has gone in 9 months from $86.7 million to $104.2 million. Pretty significant growth. This has led to a really nice operating income increase from $8 million to $16.9 million. But then we start to get some struggles. This is their interest expense, including amortization of debt issuance cost. You can see what they're paying to manage their debt, service their debt, $13.8 million up to $16.2 million. That's a significant chunk of their profits here, right? Operating income of $16.9 million, $16.2 million servicing debt. You take that out of the equation here, net income in the past 9 months, only $549,000 from $104.2 million of total revenue. Then on top of that, they have these preferred shares, dividends on Series 2 convertible preferred shares. So they are paying dividends of $3.3 million. So really fantastic top line here, but everything on the bottom, that's where it starts to get ugly. $149.2 million of total current assets is pretty good, but only $7.3 million of that is actually cash. The rest is lease receivables, loan receivables, and lease merchandise. That is on top of some pretty significant debt. Current liabilities alone here, $10.6 million on this promissory note. And then you go look at some of the other long-term debt, and it's up around $137 million. So that's the obvious reward potential here, right? The top line growth, the operating income, the business model looks really good. The problem is once they start paying all the preferred shareholder dividends and servicing all their debt, all that money's gone. None of it reaches the common shareholder. So FlexShopper came up with an option here, right? They announced a purchase option for 91% of their outstanding Series 2 preferred stock at a discount to liquidation preference, but they don't have the cash for that. They only had $7.3 million of cash. So the company came up with a solution for that, right? They're going to offer a rights offering to their shareholders. The net proceeds are going to be used to purchase back all those preferred shares, over 90% of them, and of course, service some other debt. They are going to do a non-transferable subscription rights to purchase up to 35 million units. So how does this work exactly? Well, it's a complicated way for the company to get more money from their shareholders by giving them subscription rights. Those subscription rights give shareholders choices. They can opt to buy some more common stock and get some additional Series A, Series B, and Series C rights. And then exercising those rights gives them shares in exchange for cash to the company. At their initial rights offering, they raised approximately $12 million. So that was pretty good. That was $9.4 million in gross proceeds, as well as they knocked off $2.5 million of debt. But it's not the easiest thing that I've ever seen. Even as I record this video, we are waiting to see how many units were exercised on this Series A rights offering. There's another rights offering March 17th, and then there's a Series C rights offering April 16th. So, I mean, that's pretty complicated. It's basically a 5-month financing. And as an investor looking at this company, I don't know how much dilution there's going to be at the end. And I don't know how much cash they're going to raise at the end. They need the next few rounds of this rights offering to convert, because if this company can get some cash and pay down some of this debt, looks a lot more interesting to me. Because this is really looking like a good company with a good business model that's got high growth and profitable with good margins, or at least getting there, and they're just being dragged down by preferred shareholders in debt. So if this rights offering, by the time it's finished, can knock back some of that debt into a more manageable place, get rid of some of those Series A preferred shareholders, company's looking pretty good. A little bit too risky right now for me in the middle of this rights offering, but definitely worth my time to research it. Definitely worth seeing what this company looks like after all these financings are done. And that should happen right around the time MicroCap Club is in Vegas. So good luck. Ask them some questions. As always, you've been watching Common Sense Investing. My name is Cameron. Thank you for your time.